Good morning. Welcome everyone joining today's class. Happy Tuesday. I'm Pauline Lam from Cotaroti, your 2020 Co-Chair Education Committee. Welcome you joining today's October Savor at Home and Learn. Our topic is contrasting the difference between single family home and condo regarding the insurance policy and coverage. This meeting is being recorded and will be available on our YouTube channel, West and Gabriel Valley Realtors. Before the meeting begins, and then all the participants will be muted. And should you have any question, please enter it into the chat box. The speaker will answer it during the Q&A section. Today, I'm so happy to introduce you our Education Committee member, Gloria Shaw, to introduce our speaker. Gloria, take it away.
Hi, good morning. My name is Gloria with Remax Elite Realty. I'm so glad to get such a chance to be honored to introduce our speaker. Mark Wu is an agency owner of Allstate office in St. Gabriel. He is graduate from Cal Poly, Pomona, and is very active in the community. He married to Susan over 30 years, and they have 3 daughters. Kiara, I hope I can pronounce the name well, Kayla and Cassidy. Mark has a great passion for world traveling, fishing, sports, and eating ethnic food. And he's very active member for West and Gabriel Valley a realtor. So he served 3 terms as affiliate chair, 2 years as vice chair, as well as has been awarded affiliate of the year 1999. For the past 33 years, Mark and his agency has been providing auto, apartment, business, condo, home, landlord, renter, IRA, and also retirement funding and the life insurance to the community. His staff is licensed and then can communicate with clients with Spanish, Mandarin, Vietnamese, and Cantonese if needed. Mark's business philosophy is to maintain a high level of quality of service, integrity, efficiency, while providing the proper protection for his clients. So the topic of Mark Wu today is Safer at Home and Learn, contrasting the difference between home and condo insurance coverage. Mark, you are on board. Thank you.
Thank you, Gloria and Pauline, for giving me this privilege to present to our fine members of our board. Wearing pink because I'm supporting Breast Cancer Month. I'm very passionate about serving our community and whatnot, so thank you so much. Just a note is that I am representing AMS Insurance Agency, the agency I own. And so I'll be speaking in generalities and not just on the specific companies that I provide insurance for. So as you all know, we've gone through some very challenging brush fires in the last 3 years. In fact, they say this last fire this year has been the biggest in the history of California. And what that has done in our insurance industry, it has basically crippled the availability of insurance in our foothills. So if you are closing in areas and your clients happen to have insurance already that are either with another company or the seller has insurance, you may find out at the end of escrow when you're assuming that there is availability of insurance that you're scrambling for insurance and you can't get it. So one of the things that I like to do is to inform our realtor members so that you're not caught off guard. So know that if you are in our foothills and whatnot, like anywhere from San Dimas, to Glendora, Azusa, Duarte, all the way down to La Cañada, where our board functions and even parts of Pasadena, that companies are now beginning to non-renew and not offering insurance. So I'm coming across more and more of that. So then what are the alternatives for you guys? Well, there are unregulated surplus line insurance carriers. What that means is that they're not admitted to do business in California, but they still provide insurance. And you'll have to go online to find that. And that's becoming a smaller and smaller market. The other option, as long as the house is a mega mansion and whatnot, is for us to go with the California Fair Plan. And it is considered an insurance of last resort. The maximum combined limit is $3 million. And there is a limitation that's afforded in the coverages. And I'll bring up a slide to show you what that is, okay? So the California Fair Plan, basically all insurance agencies that are licensed to do business in California can offer this. It's not a governmental program and it's not a national federal program. What it is all insurance carriers that do business in California have to be participated in this and absorb the risks. So it is, like I said, a pool of companies that are basically providing this and administered by this California Fair Plan. And what kind of coverages the Fair Plan does is that they cover fire, lightning, smoke, and internal explosion. That means a gas pipe inside the house bursting and catching in fire. You can buy extended limits, which then provides windstorm, hail, explosion, riot, plane coming through the house, a vehicle coming through your house. It's what we call a stated policy, so specific limits. So if you're insured for X number of dollars, that's all you're going to be covered for and nothing above that. The negative thing about the Fair Plan is that there's no coverage for personal liability. So if somebody slips and falls on the property and gets injured, or you have a guest that happens to get injured on the property, there's no medical payments of that. And if you cause damage to other people's property, you're chopping down a tree and it happens to fall on top of your neighbor's home or whatnot, there's not going to be coverage, nor is water damage, as well as additional living expenses. For instance, had we come through this brush fire and you can't stay in your house because your house is partially or fully burned down, there's no coverage for you to be put in someplace else while your house is being rebuilt. So it is a limited policy. However, the lenders will accept the policy. And what we do oftentimes is we add an extra policy to it to fill in the gaps. And we call it a wraparound. And so when you are involved in a transaction where you can't find any other insurance to, close the escrow deals, Fair Plan is the last resort. And you just have to educate, if you're in the foothills, your clients that, hey, there is a cost to being in our foothills. You love the serenity, you love being in our foothills, the greenery and all that, but you might not be able to get insurance. So I have, in this past year, had probably a handful of realtors call me because their clients backed out of the deal because they could not insure the home. So if you don't go in trying to educate your clients, your buyers, you're going to be surprised and doing a lot of work. And then you find out you can't get insurance. And then all of a sudden they back out and then you're starting from square one again. But if you educate your buyers and saying, hey, you know what, you're in the foothills for a certain reason, it's because you want that lifestyle and you want to be up in our mountains and whatnot. There's a cost associated with it. Know that we can do a fair plan. So as long as, again, the combined limits are under $3 million. So that is the key. If you have a mega mansion up there, it's going to be extremely challenging. The next topic I'm going to go into is just renter's insurance, on why, as a buyer, would you want to have, how does renter's insurance benefits investors? Many of you guys represent investors and all that. And oftentimes in all my training, I tell you guys, hey, recommend your investors your renters potential renters to get renter's insurance. In fact, I would require that because it not only protects the renter itself, but from a standpoint of you representing the investor or the landlord, it adds protection. What people don't realize is that it does do that. And so I try to have my realtors educated so that they can, advise their investors and provide protection for that. So many people already know that, hey, it does cover the personal property of a tenant, but how does that benefit the landlord or an investor? Well, I know that you guys have had many instances where if you are representing an investor, you'll find that hey, something got damaged, whether a pipe broke or whether something caught on fire and their personal belongings burned down and whatnot. And then they're wanting restitution from the landlord. But if they have renter's insurance, there may or may not be coverage for their personal belonging. But that's not the main thing that I like that protects the investor. Another thing is additional living expenses that a renter policy has. For instance, let's just say that you were involved in, you had a renter and the renter was renting your home and you were in a place where maybe you experienced some fire and it's a fabulous renter. Maybe the renter is Gloria and she has always paid her bills on time. I can't find another renter like that, but she can't stay in the home for 2 months. Well, if she has renter's insurance, she continues to pay me the rent. And let's say it costs her more to stay someplace else. The renter's insurance will pay the difference of that amount so that I don't lose her as a tenant. Because if she doesn't have renter's insurance and I don't want to pay for her to be put someplace else for 2 months, most likely I'm going to lose the lease and Gloria goes someplace else. Now I can't find a fabulous renter like Gloria. And so that's another reason why renter's insurance can benefit the investor. But another issue is, let's just say that Gloria causes some liability issues. Her dog bites somebody on the property, or she leaves something on the sidewalk and somebody trips over that and breaks their leg. Or Gloria happens to be hosing off the sidewalks and somebody slips and falls and gets hurt. If she has liability insurance on her renter's policy, then we will pick up that. And what happens is that often the person that's injured will get an attorney to represent him, and the attorney will sue Gloria and will probably sue the landlord. Well, if Gloria has a policy and liability, they will go after that first. And then all those instances that I talked about where there's a liability issue, the renter's policy would afford coverage if they find that Gloria was negligent. And therefore, the person that got injured won't have to go after the investor on their policy. And so there's no claim on the investor policy. And that is how you protect the investors and landowners, and why renter's insurance is a benefit. And again, when we're talking about an apartment, it's $20, $30 a month. When you're talking about a nice big home, maybe it's $40 to $60 a month. But nevertheless, it really protects the investor. And in this market where it's hard to get properties because there's such a great demand, it's very easy to convince a prospective tenant that they are, that something that will help them out is renter's insurance if I'm to consider them as a tenant. So again, if we're in a challenging market where, there's lots of vacancies and all that, then that becomes a harder issue to do. The next thing I'm going to go to is condo insurance.
Mark, take your time, and if there is some question from the audience, I'll let you know. So I have some client having the tenant like insurance, but I just want to know some kind of like personal belonging. Some are the furnitures. So is that a requirement? Have a wet insurance from the landlord? Is this a required, or the tenant can do it by themselves?
Okay. I'll answer that question and I'll get back to my slide and thank you.
Sure, take your time, Mark.
So you can require it, but you can't purchase it for the tenant. All right. The tenant has to have, the tenant is the one that signs the application and the contract, because if they're coming to me, for instance, Gloria is the investor and she has a tenant of Pauline. All right. Gloria can require Pauline to buy the renter's insurance, but it's only Pauline that can sign up with me to buy the renter's insurance. So Gloria can't, as the landowner, cannot be entering into a contract with me to buy renter's insurance for Pauline. So hope that answers the question that person has. So I'm going to go to now condo policy, and I'm going to use an example where I'm representing Gloria as a realtor. Gloria is a cash buyer. And this is something that I continue to find in the industry. Not a year has gone by where I'm shocked that the realtor didn't recommend the buyer to buy the HO6 or condo policy. And I'm going to go through a scenario of why that could put you guys in a very challenging position. So first of all, a HO6 or a condo policy now is required. You know, when I was an agent in the first 15 years of my career, it was never required, even if it was somebody that's buying a loan. But Fannie Mae came, and in the end of 2008, when we had the real estate crisis and all that, what they found out was when they took over all these policies, all these mortgages from these lenders that defaulted and they were having claims, they found out that many times the master policy didn't cover a lot of the damages inside. So they came back and required what we call a 20% requirement. So if Gloria goes and she buys a condo, right, and it's a certain amount, let's say the condo is for $500,000, then Fannie Mae is requiring us to put 20% of that purchase price as a structural coverage on our condo policy. And the lenders are also requiring you for that. So it's not an option anymore. But why is a condo policy needed? Well, first of all, I told you a condo policy is needed because Fannie Mae now requires it. But many people assume that in condo insurance that the master policy protects all the coverages that they need. And they don't recognize that the association policy only covers for the common walkways, the common areas, the elevators, you know, the parking lot and whatnot. And also, you know, the master policy only covers what is considered common areas. So you can have a structural, even if it's an interior wall, and on one association, they may say that you're required to cover that. And in another association, CC&R, it may say, no, it's the HOA that covers that. So that's another reason why you would need a HO6 condo policy. And also the HO6 policy, condo policy, covers the buyer's personal belongings. It also covers the buyer's interior liability. It also covers loss of use, where the master policy excludes all of that. And I will go through a scenario where you will see that. So what actually determines what is Gloria's responsibility in her condo and what is common area in her condo? And the thing that tells you is the covenants, conditions, and restrictions. So it's super, super important for you guys as realtors not to just go and look at a condo and just because they have common walls say, oh yeah, the master policy all covers the structure, because that could be a totally inaccurate statement and you can expose yourself to an E&O claim. All right. So the CC&Rs in the insurance section will define which of that structure is Gloria's responsibility. Once it becomes Gloria's responsibility, then the condo policy that she buys through me or any other insurance agent, then that dwelling portion will cover that part of the structure. So things like wind damage, you know, can happen to a condo, a falling tree. If you guys remember, about 3 to 5 years ago, we had these horrendous Santa Anas, and they topple trees all up and down Arcadia, Huntington Drive, Boulevard. And so naturally everybody knows fire causes damage, to a house, then there's going to be coverage afforded. So again, the first part of the dwelling coverage, a condo policy, is the dwelling limits. As I told you, it's 20%, and it covers it covers whatever the CC&R defines that is the responsibility of each condo owner. The second part of a policy, of a condo policy, is personal property protection. So that typically covers things other than business property. So it'll cover things like furniture, clothing, fine arts, electronics, jewelry. And again, certain companies put certain limits on some of these items, but on the whole, whatever you're putting on a moving truck and moving in, a majority of those things are considered personal property. Loss of use. So what that covers is the expense, and that it's above and beyond what a person normally has. So again, here's a situation where Gloria condo gets burned down, or part of it's burned down, and she can't use it for 2 months. The personal condo policy, or the HO6, will pay for her to be put someplace else while the condo is being rebuilt. And then liability. This is super, super important. Probably the biggest part of a policy. Again, Gloria has a dog. That dog bites somebody. The master policy will not cover any of that liability exposure. Or she is the one that caused the liability injury to somebody that was inside her condo unit, or even if it's in a pool area and they're horsing around or whatnot. The master policy will cover zero amounts if she's found negligence for any injury sustained by somebody else that happens to be injured in or outside the condo. And so that's an important thing. It also has medical payments. So it could be where she's throwing a party and somebody gets, she has to call an ambulance because somebody got injured, maybe not out of her responsibility, or maybe out of her responsibility, but that person's not going to sue her. So Pauline gets injured inside her condo, and they call an ambulance, and that ambulance costs $800. It could be picked up by guest medical that a condo policy will have. So let's just say whoops, actually I was updating everything, and anyways, here's a case scenario. Again, I haven't been through Mark Wu's insurance classes, and I haven't gotten good training from the West San Gabriel Board of Realtors. And Gloria is a cash buyer, and she buys this condo. And she goes, Mark, do I need to buy the separate policy? Technically, the answer is no. She does not have to buy this HO6 policy. So let's go on the premise that she received an email from me saying, don't worry about it. We can close escrow, and you don't have to have a condo policy or a HO6 policy. That is a true statement, but that statement is going to get me in a world of hurt. Whoops. And here's what happens. Her condo burns down. Her whole condo association burns down. All right. The master policy had $2 million worth of coverage on it, but it cost $2.2 million to rebuild the whole thing. So we're short $200,000. And the reason why there might be a shortage is maybe there's been a lot of losses like we've had where there's a lot of fire damage. So resources are costing more. The demand for contractors are great. Therefore, they're not going to give the best price. They're not going to give discounts. In fact, they may even start charging a little bit more because everybody wants them. And so then she had $50,000 of interior loss, and she lost $55,000 in contents, and it's going to cost her 10 months to rebuild. How does that impact her? Well, had she gone on my recommendation on only the master policy, that $50,000 is going to be zero coverage from the master policy. She has no coverage whatsoever to build her interior walls. Had she bought her condo policy through me or the HO6, because I, as a good realtor of West San Gabriel board, recommended that she buy it, even though she was like all cash buyer. She would have had afforded up to 100,000 for any interior structure damage that was her responsibility. So slot to the right, you see that 50,000 would be picked up. Also, all her personal belongings, like her Louis Vuitton a purse and her stiletto shoes and whatnot, and her furniture and her washing machine and her TV and computer and all that. The master policy pays, again, $0. Whereas had she bought the condo policy, we would pick up that whole $55,000. And then she can't stay in her 3-bedroom, 2-bath condo for up to 10 months. And we're in Arcadia. Now, $2,500 for a 3-bedroom is very cheap, but I just want to give you a minimum policy. But that would be another $25,000 out of her pocket that the master policy would pay nothing for. So she would have to pay that out of her own pocket for the next 10 months, while her condo being rebuilt. But what about that 200,000 that we were short? All right. Who comes up with that money? Well, all the unit owners has to come up with that money. So that the CC&R says that anything that our insurance doesn't cover has to be divided proportionally by the number of owners. In this situation, we were short $200,000. So we would divide that 200,000 by the 5 unit owners, and each of us would have to come up with 40 grand. We would, again, had she had that loss assessment, we would come up with her 40 grand. And so you could see that the total claim would be well excess over, and actually my thing is being covered, I forgot, but it's over $170,000. So by me stating to Gloria as a cash buyer and as a realtor, hey, don't worry about it. Now she has an email from us. Guess what Gloria does? Gloria is going to be very upset and angry because she trusted in my expertise to nurture her, to advise her through the escrow transaction. And she doesn't think about all the great deal I got, or even I got her the condo at this challenging market. Gloria is upset, and she is going to try to come after me on my E&O. And then I put myself in litigation. Again, the other 2 things that I mentioned, the guest medical, I gave you the example of Pauline as an invited guest getting injured and calling an ambulance, and we can claim that on a condo policy. But the family liability is super important. If I use this situation where we're on a common area, meaning the swimming pool. The swimming pool is a common area place. But let's say that she has children, and her teenage son invites somebody to the pool and they're playing horse and they're playing around, and he happens to push his buddy into the swimming pool because it was fun and all that. And unfortunately, I've done that as a kid, and I know young people do that. But let's say that teenager his friend gets injured, and his friend's parents happens to sue Gloria. Well, if she has this HO6 policy, many policies come with 100,000 personal liability. So therefore, there would be coverage afforded if her son is found to be negligent, which in this case, he would absolutely be. Or Gloria happens to have a dog, and that dog happens to bite somebody. In this instance, the master policy would cover zero amount, but Gloria's condo policy would cover up to $100,000 of family liability. Or another situation that has happened is that maybe she's in a 2nd-story building and she has pots, plants and pots up there. And it happens to one day she's watering, and that pot happens to slip off the balcony and crack somebody walking by on the head. Again, the master policy would cover $0, but her policy would afford coverage because she was considered negligent and the injuries caused by her accident. Okay. And the last example I'll give is her washing off the sidewalk and driveway. It happens to be where she's washing her garage down, but now the common area gets wet. All right. Then in this instance, we would afford coverage if she's found to be negligent, if somebody walked by and slipped and fall and got hurt. flipping in, what if somebody came in and got hurt inside her resident? So again, I gave you a situation where Pauline's a friend, not going to sue her. But what if the situation happened where her kids are inviting over friends and they happen to be horsing around and somebody got injured within her condo? Well, the master policy, again, affords zero liability coverage because it only covers liability in the event that it's in a common area and not the negligence of one of the unit owners. The condo policy would afford coverage for that. So this is the scenario where a condo policy in our market normally is under between $500 to $1,000, depending on the cost of the home. Because remember, that determines amount of dwelling coverage I have to put on a HO6 or a condo policy. So where your buyers are spending $40 to $50 a month, and by not getting that, you could see all the exposures that you may put them in the event that they aren't they don't buy that policy as a result of your advice. So that's the topic on condos. And now I'm going to go to my last topic, which is homeowners. And thanks for bearing with us. Okay, so home insurance, commonly called hazard insurance or fire insurance, is property insurance that covers private homes. So it covers any home that an owner occupied 1 to 4 unit. And it is required. And the most typical type is the HO3, and I will always recommend that being the one that's bought. Why I recommend this is because it's an all risk coverage type of policy, meaning that as long as there's not an exclusion, then the property is going to be covered for any perils that happen, like what I indicated before, like fire, wind, hail, and smoke. And I'll show you that in a second. Like the condo policy, it also gives dwelling coverage. But what's different about it is that it's not 20% of the home value. But when we figure out the dwelling amount, it's the responsibility of each insured or the buyer to determine whether or not the coverage being afforded to them by the insurance agent is going to be sufficient enough to rebuild. So again, it's not my obligation and responsibility to make sure that they have sufficient, although I'll be giving an advice of that, but it's the responsibility of each buyer to determine whether or not, once me and my staff say, hey, this is the amount of dwelling coverage that needs to be done, that you need to have, that the insurer or the buyer needs to be secured with that aspect of the coverage. Then we also, most policy covers other structures. So they will cover 10% of the dwelling amount. So let's say in the example again, if I am insuring Gloria's house for $900,000, she will automatically get 10% or $90,000 for any other structures. These other structures are considered things like sheds or detached garage or retaining walls or patios or sidewalks or driveways. And sometimes we are in situations where the other structures are more than what the 10% is. In that regards, then it's super important for your buyers to have a conversation with their insurance agent that they need extra coverage on other structures, and we can do that. So again, 10% is automatic, but if they need more coverage, they have to let their insurance advisors know about that. Then it also covers personal belongings. And again, that's everything that they're moving in with limitations. And there are limitations also in business property. So for instance, if Gloria is not a plumber and she has a lot of tools and whatnot, $2,000 to $3,000 to $5,000 worth of tools, that's going to be covered under our homeowner HO3 policy. However, if Gloria is a plumber and she uses those tools in business, then there may be a limitation on that. And oftentimes that's like a $500 amount. So again, it's super important to be able to have that conversation with your insurance agent. Coverage D is the loss of use, and I talked to you about that. It's super important. Some policies don't have some policies, most policies do. And this is where we will put, if Gloria is in an Arcadia house, and let's just say she's in a 4,000 square feet home in Arcadia, and that house burns down, we have an obligation as an insurance company to put her in what she is accustomed to. So we can't put her in a motel 6 one bedroom motel for the length of time that her house is being rebuilt. We have to put her in what she's usually accustomed to. I remember a case early on in my career where an insured had a home in Malibu, and that was a 10,000 square feet home. We had to put them in a 10,000 square feet home when the house was destroyed for up to a year while their house was being rebuilt. And that was very expensive. We talked about liability, right? Where in case something happens, and I gave you all the instances of liability that were a part of a condo, those same liability cross over. But where it can cross over here is, let's say Gloria is chopping down a tree, and she tried to do it in a nice, great way. But unfortunately, the tree started falling on her neighbor's property and damaged the neighbor's car and the neighbor's home. Personal liability would extend to that. A couple other kind of liability issues may be, if you're anything like me, you love to travel and you love to get on airplanes and all that, but you hate to pay those baggage fees. So we're stuffing those carry-on bags, and they're pretty heavy, and sometimes it's hard to put it up on top of the airplane carriers, overhead carriers. And if that happens to slip off my hand and fall on top of another passenger and injure them, believe it or not, personal liability affords coverage for that. Or if I like to play golf and I happen to be playing golf and hit somebody with a golf ball, or on a backswing, I happen to crack somebody's head, or if I play baseball, whatnot, again, personal liability even picks up in that event. So liability is a super important thing. And whereas on a condo, maybe 100,000 sufficient, on a homeowner's, my agency and myself, we often try to advise a client to get 500,000 to $1 million, because what attorneys tend to do, and hopefully attorneys, you don't get upset at me if you're on this, but they try to go for lots of dollars. And so, oftentimes it's trying to get as much as what your house is worth. And if you have 500,000 to $1 million of coverage and your house is not worth up to that, then the policy pays out and you don't have to jeopardize, a person filing judgment against your home. And then I talk about medical payments where, hey, it's a friend, you invite them over, they get injured, ambulance comes out, charges $800. You don't have to be negligent, but you can say, you know what, I feel bad because it was my party. I want the medical payment to pay it. So therefore I'll let the medical payment pay the policy. Pay the ambulance fee, and the homeowner HO3 policy can pay that. But I want you to know, not all insurance policies are alike. And this is super, super important. If you haven't been paying attention to any of my topics, just go through the scenario with me for a thing, because, many of us love the discount. And oftentimes, if we're getting a quote proposal from these 3-4 carriers, and we look, oh gosh, I see the dwelling coverage at 900,000. And then you go, oh, the fair plan is 1,500 versus company A's policies for 1,800. So I advise my client to go for that $1,500 policy. What is going to happen? How do I jeopardize my client when I refer him to get the cheapest policy, because I'm thinking it's all the same coverage. So what does it matter? Remember, I went through the scenarios of the fair plan to refresh your memory, where the fair plan doesn't cover a lot of different claims. But let's just say that it happens to cover a fire damage. All right. So we're in a situation where I was insuring Gloria's house for 900,000, and now it costs $1.3 million to rebuild. What causes her house to cost $1.3 million to rebuild? Well, insurance companies all have a guesstimate, or not a guesstimate, but they have a calculation and a module of what it's going to cost them to rebuild a home that a potential insured is going to be getting coverage for. But we don't, in order to get an accurate estimate of what it's going to cost to rebuild the home, we have to have all the tradespeople, whether it's the architect, the cement guy, the foundation guy, the drywall guy, the framer, the roofer, the AC, the electrician, the plumber. We have to have all those tradespeople come in, give us a projection of what it'll cost. And then that would give us a better estimate of rebuilding costs. But because we don't have that capability to do that, nor would all these contractors want to give us those bids, because there's no job to be had unless there's a total loss. We have to have a great estimating forecasting tool. And so companies each have their own independent ones, and that's how they come up with, this is what they estimate cost to rebuild. But remember, they're not guaranteeing that that's what it's going to, that there's going to be sufficient enough of dollar amount. So what they do in return is they give what they call extended limits. They give a percentage above what they're going to cover to make up that, so that we're going to be in the ballpark and hopefully we'll have sufficient enough coverage. So company A's estimated extended limits is 50%. Companies B's extended limits is 25%. Company C's extended limit is 20%. And like the FAIR plan, they're a specified limit policy. So all they're going to cover is $900,000. All right. But again, Gloria's total loss was at 1.3 million. So if Gloria went with she took her realtor Mark Wu's advice and went with the cheapest policy, here's what's going to happen. She is only going to get up to 900,000. So Gloria has to pull out 400,000 out of her pocket, and she's not going to be a happy camper, will she? If she went with company C, her policy pays 20% above that. And the way you figure that out is it's 1.2 times the 900,000. So her policy's limit is 1,080,000, and here she's going to be 220,000 out of pocket expense. And then company B is 25%. So although she doesn't have to pull up the 400,000 that she would have out of company C, out of the FAIR plan, this person also, in this regards, Gloria would have to bring out 175,000 out of her pocket. However, if she went with company A, even though that cost $300 more than company the FAIR plan, the company A affords 1.350 coverage, and so in this case, she would pull out nothing out of her pocket. It rebuilds for the whole amount. So again, this slide, out of everything that I've spoken on, is probably the most important slide and topic of mine today, is that don't always go with the least expensive, but know what the extended limit is, so that you can, if you're advising your clients to go a certain way, then your clients go that way. But what I would always recommend is have people that are part of your team that are ethical and good. And so, if you have an insurance advisor on your team that you refer business to, let them be the ones that talk about insurance coverage. Don't take what your insurance agent advisor gives you and regurgitate that and then tell your buyers what that is. Because if you happen to do a misstatement, then you pull yourself into an E&O situation, and we as a board and your brokers don't want you to be involved in that. So what are 5 key questions to ask your insurance agent? All right. You don't have to remember the percentage. Did Mark say 50%, 25%, 20%, whatever? The easy question is, Mr. Insurance Agent, what is the maximum this policy will pay? So if you're asking company B agent, hey, what's the maximum your policy will pay? I don't have to remember, well, is it 900,000 times 1.5 times 1.25 times 1.2 or a specified limit? All I have to do is to know he's going to tell me 1,125,000. All right. And then in event of covered loss, will all my personal belongings be covered on a replacement cost basis, or will they be replaced on a depreciated or fair market basis? How does that work? Well, let's say Gloria has a big screen TV, and that big screen TV was a 80-inch Sony screen TV that she bought 3 years ago. All right. If she doesn't have replacement costs on her homeowners, then what a company will do will say, well, what could Gloria sell in the open market, that Sony 80-inch big screen that's 3 years old? You know, even if she paid $4,000 for that TV 3 years ago, maybe they would only give her $2,700 because they put a depreciation schedule to that. However, let's flip it and say that TV set now costs $6,000 today. All right. We would pay for that if she had replacement costs. Or that could be a piece of furniture that's 10 years old. It could be her washer and dryer. You know, she happens to have a washer and dryer that's 10 years old, that's functioning, but it burns down and we can't get that. We'll get her a light quality, light material washer and dryer if she has the replacement cost. Then we also said, hey, does it have liability? Remember, the FAIR plan had no liability, where most HO3 policies all have liability and come with 100,000. But again, I recommend 500,000 minimum to no less than $1 million. And then, does my policy cover any building code upgrades? Her home burned down in Arcadia, and even if it's a 3 to 4 or 5 year old home, building codes are changing constantly because the cities are making them bring it to current building standards. So many policies have this coverage, but some policies don't. And so you don't want to have recommended a carrier that provides no building code upgrades, and then Gloria finds out, hey, she has to pull out 30, 40, 50,000 out of her pocket to bring it to current building code standards because the city of Arcadia is requiring her to do that when she rebuilds. And then again, does it pay for any additional living expenses? I had several realtors in this current situation where they went back to their agents because they were in this brush zone where they were told to evacuate because they couldn't go and live in their house for a week, 2 weeks, whatever. Additional living expenses would pay for that. Whereas if she hadn't had that, then additional living expenses doesn't. So that is the end of my topic today. Thank you for bearing with me for these last 50 minutes. And now for the next 10 or 15 minutes, if you have any questions for me, I will do my best to answer them.
Excellent. Thank you so much, Mark. Great job. We are getting a little bit more knowledgeable after hearing your class. I think it's great. Let's say we have several questions in our chat box. So this is our question and answer section. So Mark, they have the question, first one from Shirley Ho. Her question is usually how much cost for renter insurance?
Yeah, and that all depends. It's kind of like me asking, well, how much costs for a home? Well,
Okay.
depends on the size and whatnot. So, but again, on the average for a 1-bedroom apartment and all that, you're paying around $20, $30. You know, for $1 million home, you might be paying, you know, hundreds of dollars a month, but it's very inexpensive.
Okay, great. Next question from D. Lee. Does a landlord need to inspect tenant insurance annually? What kind of key points landlord needs to pay attention to?
That is an excellent question. And I tell you, your renters sometimes are very smart. They'll go and they'll buy renter's insurance from me, show the landlord or the realtor that they've gotten insurance, and then in the next month they cancel it because they don't want to pay the remaining amounts. So how you can avoid that is that we can't put the landlord as a additional insured, meaning that we also cover them. All right. But what we do out of my office, if it's requested, is we put the landlord as an interested party. What that means is that anytime that your renter is buying insurance from us, you as the landlord or you as the investor will also get a policy. And so if they cancel, we'll send you a cancellation. If they renew, we'll send you the coverages that they renew for. So if they have a loss, we don't pay you, we pay the renter. But again, how this helps you out as being put as an interested party is that you are on the policy to be notified if something happens.
Okay, great. We have another question from Bernard. The question is it correct that the insurance will not cover earthquake if the house foundation is not bolted down?
That all depends on the company that's insuring and affording coverage to you, but we can get insurance on a earthquake insurance if a house is not bolted through the California Earthquake Authority. And you have to go with the company that you have your homeowners with. So we always recommend that because they have to match the coverages that are on the dwelling amount. So can you get insurance if your house is not bolted? The answer is yes. With some companies, again, it's on a carrier to carrier basis.
Great. So Joyce King said it's webinar recorded. Yes, it's recorded. Next question, we have Sophia Chang. What's the advantages for renter to buy renter insurance when we convince them to buy?
Well, so I gave you the advantages to a landlord for you to convince your renters to buy it. But from a renter standpoint is, again, Gloria is renting my house and she loves my house. She doesn't like any other house and she knows it's going to be hard to get another house and all that. But what if my house catches on fire that I'm renting to her and it's going to take 4 months for her to rebuild? I mean, for me to rebuild it. Her renter's insurance would not only pay for all her personal belongings, but would pay for her to be put up someplace else while my house is being rebuilt. So that's the advantages in that her contents are covered, with limitations on the policy, meaning her furniture, stereo, appliances, clothing, jewelry is covered. Her family liability is covered. The same situation, her dog bites somebody, or she's playing golf and hits somebody, or she's traveling and drops the suitcase on somebody. Liability on renter's policy also affords personal liability coverage. So it is something good to have, very inexpensive. And I would just make it expectation, for any renters that you happen to have on your investor's property to obtain the coverage.
Great. We may have a last question, okay? We have Cecilia. The question is, unfortunately, there is an unintended death in the car, from car. What do we do? Is that
For the unit, yeah.
For the unit? So where that the insurance cover?
Okay, Celia, thanks for the tough question, girl. Celia and I go back a long ways, I think almost 30 years. So I appreciate her even attending. But unfortunately, that's not a covered peril. Whether you're talking about removing a body or loss of income, can you clarify what you're trying to get at? And I can address the question.
Maybe some criteria, huh?
Can I?
Yeah, yes.
Yes. Okay. So unfortunately, this did happen to us, and the unit was uninhabitable.
Due to the person dying?
The person died in the unit.
Okay.
Of natural causes, but we're waiting for coroner to come now, and there's no heirs. There's nobody to contact. There's nothing. So, and the unit will have probably 10 grand worth of fix-it work.
Yeah. So unfortunately, there's no insurance policy out there that covers that. So.
Really?
Yeah, it's not a covered peril. Insurance is considered sudden and accidental, which I guess death can be considered sudden and accidental, but it covers things like fire, wind, hail, smoke, explosion, falling objects, and whatnot. But it never covers, death within.
What about hoarders? Does it cover hoarders?
It does not. That's not a covered peril, although there may be instances where you can go after the hoarder's liability if they create, they damage, but they have to do, it has to be kind of like, you'd have to prove that they cause damage, and there could be possibly some coverage out of their liability, out of their renters. I have not experienced that or come across that, but that would be something actually very worthwhile for me to look into.
Thank you.
Thank you so much. So wonderful participation from our
Answer the
audience
last
and
one,
wonderful,
if you don't mind, Gloria.
wonderful
A very good
classes.
question.
Thank you so much. Do you have any other question? The question for next seminar, okay? Do you have anything to say, Mark? Okay.
No, I think there's one quick one that I want to make
Okay.
sure that, because Clint Ling asked, hey, if you don't have earthquake insurance, will the government step in? And the answer, very simple answer to that is no. The government, FEMA only comes in with a temporary loan of 5, 10, 15, 30,000, but never to rebuild. That's why we have the California Earthquake Authority. So don't whether you see the disasters of the hurricanes or the floodings, back east and all that, and thinking, hey, yeah, the government comes and steps in, they only provide temporary shelter and food and clothing. They will never provide coverage for you to rebuild. Please don't assume that. So my advice to all the realtors is always advise your clients to purchase the policy, and that keeps you out of trouble. Or have me or somebody part of your team that will advise your clients. That way you're not the one getting yourself in trouble.
Excellent, excellent. Thank you so much, Mark. Really appreciate it. Great knowledge. We're going to work accordingly as a realtor to provide sufficient advice to our client. Thank you so much. Thank you, participants, everybody. So up to you. It's Pauline. Back to you. Thank you.
Great. Thank you so much. Wow, this is a very important and knowledgeable and informative section for us regarding how important to buy a correct insurance policy and coverage. Not the money you pay, it's the money you want to get back, right? And as much as the good coverage and good policy, it is very important for our industry. I really want to thank Mark, and thank you, Gloria, for your wonderful section. On behalf of West and Gabriel Valley Realtors, we would like to thank Mr. Mark Wu from Allstate Insurance for your informative and wonderful presentation today. We really learned a lot. And before the meeting adjourned, I would like to remind you, stay with us, join all our upcoming classes. This Friday, 2 o'clock, the national speaker and coach, Mr. Mark Given, brings you a very good topic, trust-based selling in a socially distant world. And next Tuesday is our second Dive and Thrive series. Miss Shelley Coffini brings you short sale and forbearance. This is very important for us to know and prepare for the maybe possible coming up situation for real estate market. And next Wednesday, 11 o'clock, Vincent Zhou would like to share us how to price a land project and what is the land value, how to you judge it and calculate. And next Friday, very important, I invite all of you, not only broker, all the agents, please come to join our broker symposium. It's from next Friday, 10 o'clock to 12 noon. And the special speaker from CAR and MRs and our attorney, Mr. Jim Klinker, will give us a lot of update. And it is tremendous information and wonderful information I want to share with you. And please register and come. And the coming Friday's class is no recording. So make sure you stay tuning at 2 o'clock this Friday, October 23rd. And before the meeting adjourn, I want to thank you again, Mark. Thank you, Gloria. And thank you all of you joining education committees, all classes. Stay happy, safe, and healthy. We see you Friday, 12 o'clock. Thank you.